A lot of what I'm talking about is familiar to me because I've grown up with Heartland, so the history is something I've seen and the future is something I'm living with now, or we're starting to try and form now. We're going to run through a presentation as I speak here. Emma, can we flick up the first slide? So here's some Heartland at a glance, some key facts about Heartland, and these are all about, so 2.5 billion of assets, 2.1 billion of liabilities. Net assets about 370 million, mostly tangibles, some intangibles in the balance sheet, but about 340 of NTA. About 8,000 shareholders. Our biggest shareholder is Greg Tomlinson, who holds just short of 10%. Not many institutions in the register, hard to see sometimes though, because you know, they're hidden behind nominees, so not many institutions in the register. Heartland New Zealand Limited, although it's a listed entity, but basically what it is, it's a holding company for a bank. So although Heartland New Zealand Limited could be other things, it's got a JV with AA out the side, and other things could be tagged onto it. Basically the story of Heartland is a story about the bank. So the bank has got a investment grade rating both from Fitch now and S&P. It's a relatively small size. The market probably thinks of its peer group as being, say, TSB, SBS and Co-op Bank. We actually think we're very different from our peer group. I'll touch on that later. One of the things, of course, that distinguishes Heartland from its peer group is that Heartland is held by an NZX listed company. So I think of it as a sort of a closed circuit system. You know, mum and pa can invest in Heartland shares. We process that, and at the bottom end we're making loans in the market to ma and pa. All of our lending is New Zealand based and will stay that way. Can we flick on to the next slide, Emma? So Heartland's come a long way, we think, in a relatively short time. So formed in 2011, 3 financial services entities coming together, a couple of building societies and a finance company. That finance company was Marrick. So it had a strong brand in motor vehicles. The building societies had strong depositor bases, but their asset base was different. So formed in 2011, listed in 2011, got into the NZX 50 in 2011, thanks very much. Grew through some acquisitions, acquired PGW Finance, that brought the balance sheet up a bit. All of this time we're working on the path to bank registration, and that's something we achieved at the end of last year. So my whole speech is spoilt because until today we could say we're the newest bank in New Zealand. Now we're not. The Chinese have come in and gazumped us. I'm sure that'll never happen again. So I think what's important here is that as an organisation we've delivered on the promises we've made to date. We've built a bank. So we built the platform. We built the platform for the delivery of sustainable and reliable returns to our shareholders. And it's been achieved in a relatively challenging environment. I don't need to talk about the GFC. It's not been easy. The regulatory responses to the GFC have not been easy. And of course we're dealing in a low credit growth environment, so it's hard for financial institutions as it is. And usually where you see a financial institution, a bank reporting credit growth, you often see that's accompanied by reduced margins. Interesting. So long way in a relatively short time. So we've built a platform. But as well as building the platform, we've taken care of some fundamentals. Lindsay Pine from BNZ days, he's actually made a lot of money up now in Thailand, I understand. Liked to say that banking was a factory. Your inputs were your deposit base, and the market would set your cost on those. Your outputs were your loans, and the market would set your return on those. It was all about being efficient in the middle. Don't agree with all of that, but efficiency in the middle is fundamental to sustainable returns, reliable returns, good returns. So over the past 3 years we've got some fundamentals under control, and these graphs are normalised. I know that's an awful word and I'd be slapped around the face by the FMA for using it, but they're normalised. They're normalised to take out something we did at the end of the 2013 financial year. What we did is we backed out a whole reinsurance arrangement we had in relation to our property portfolio. We call it the legacy property portfolio because we don't want to think about it. So they're backed out to They don't include what we did at the end of last year to show what we did with our legacy property portfolio. These show underlying trends. Cost of funds, there's no normalisation there. Cost of funds has been coming down and continues to trend down. That's important, obviously, because that's the input to the factory, cost of funds. OPEX ratio, wow, 80%. This is December 2011 OPEX. And this was historical, you know. Building societies coming on board, they had a high cost base. They didn't charge much for their loans, so OPEX ratio is high. That's coming down. We're now at the end of the September quarter, 54%. So OPEX ratio has dropped to 54. It's got to get down further, but we're getting close to where we really want to be. And impairments, really important one. Underlying impairments are going down. This is fantastic, because impairments were that great swing in our NPAT. You know, we could be making good underlying profits, but as impairments came through, they could hit those, wipe them out. So that's normalised. That's pleasing. So we've built a platform for delivery of sustainable and reliable returns. We've taken care of some fundamentals to help secure these returns. So I just want to put up some data. Emma, can we flip to the key data? This is point-in-time data. Share price 86 cents. Nearly 400 million shares. There's our market caps. That's about NTA. Shares are trading at about NTA. Current year projections, NPAT 34 to 37. So return on equity in the 9s. It's not 10% yet, it's in the 9s. Earnings per share, 9 cents. So there's some key data. Flicking on, because I want to look at some benchmarking. So this benchmarking is looking at where Heartland shares are trading compared to other Australasian financial institutions. I think it's quite interesting. We're trading at about, we're trading at NTA, just slightly under, I think, but at NTA. Other Australasian financial institutions, and the group here is ASB, CBA, Westpac, ANZ, Bank of Queensland and Bendigo, you know, averaging 2 to 2.5 times NTA. There's some outliers in that, but 2 to 2.5 times. Wow, what's that showing us? That's, I think, showing us that the market is saying to us that we're not generating the returns from our asset base that we should be. That's what the market's telling us. Other interesting one is price to next 12 months earnings. And we're sitting at about 10. The comparison's about 12, 13, 14. So again, we're just not quite there. That's actually interesting because circling back to our ROE figure, we're 9, creeping up towards 10. Bendigo, I think is 8. It's 8. It's 8%. Bank of Queensland, I think, is 10. ROE. So, but we're trading at less, next 12 months earnings. So again, the market, I think, is trying to get its head around our story, go forward story. Maybe we're undervalued, just chucking that out there. Next chart, Emma. This is a really interesting one, total shareholder return. So we're the black line, the NZX 50 is that green line. Look at that. That's actually quite good. Taken from June 2012, so I could be criticised for being selective, but that's a really interesting trend. So share price growth, and we've become a dividend payer. That's interesting. So total shareholder return, that's looking pretty good. So we've built a platform, we've taken care of some fundamentals, and we're creating shareholder value, but we're trading at a discount to our peers. So I'll move on. I want to talk about strategy now. I've just thrown up a couple of slides here. Just this is kind of the segue into strategy, because how do I get from where I've been talking about to talking about strategy? The guy on the left is Field Marshal Helmuth van Moltke, a Prussian, and he liked to point out that strategy is a bit more than a grand plan. The guy on the right, we all recognise him. He's Mike Tyson. So van Moltke said strategy's got to be more than a plan, because a plan starts with an end point and you work backwards, and it's a bit rigid, a bit restrictive. Things go wrong. So van Moltke said that no plan survives contact with the enemy, and Mike Tyson was a bit more pithy about it. He said that everyone has a plan until they get punched in the mouth. So kind of strategy's got to be a bit more than a plan. So our strategy needs to cope with a world in which things change, in which you'll get unfriendly fire. So strategy involves employing available resources to achieve the best outcome you think you can achieve, or the best outcome you can achieve, in situations that are dynamic and contested. So that's my definition of strategy. It's not a plan, it's more than a plan. Can we move to the next slide, Emma? Now, just a bit of theory here, because my background is as a lawyer and I love economics, curiously. Bit of economic theory here. So the economic theory is that you create value by getting to what they call the productivity frontier. You kind of values everywhere on this frontier. Doesn't matter where you are on the frontier, but you've got to work out where you're heading on that frontier. Because there's value everywhere. Now, I think most of our peers are probably working along this axis here. They're competing on price, trying to be very efficient to compete on price. All praise to that, but they're competing on price. Now, that's a wonderful place. They're still getting to the productivity frontier. They're employing their resources well. They're going to create value, but we're in a different direction. Not to compete head-on with the other majors. Offering the same generalist product in this market is not a viable strategy for us. We'll get mowed down. New Zealand doesn't need another bank doing more of the same. What we are doing, and will continue to do, is add value through differentiation. We're headed up here. We want high differentiation. It won't be lowest cost, but we'll get customers willing to pay for that. We'll increase their willingness to pay. That's what WTP stands for, willingness to pay. We'll increase their willingness to pay by offering them a better product. By doing that, we'll command a premium price. So what I have in my head all the time is that we're niche, not bandwidth. We're not going to be all things to all people. We're going to be product-centric. We want to be known as a specialist bank. So how's this working in practice? Market position. So our focus is on three sectors: household, rural, SME. We want balance across those sectors. We don't have that yet. We're still weighted towards consumer and retail, household. We want to build up more in rural and business to get to balance. So we're about 40, 25, 25. The other 10's the non-core property portfolio, which I'm not going to talk about. It's 40, 25, 25. Want to get balance. And in each of these areas, we aim to identify a niche where we can actually take a number one or two market position, and by grabbing that number one or two market position in that niche, we can command a premium on what we sell. So some examples, like in household, we won't do residential mortgages. We don't write them anymore. We don't do residential mortgages. It's really hard for the RBNZ to get its head around this. We were going through the bank application process. We don't do residential mortgages. Every bank does residential mortgages. No, we do motor vehicle finance. If you come to us and you want a mortgage, we'll write you a Kiwi Bank mortgage. We've got a white labelling relationship with them. In rural, we don't do rural mortgages. We do livestock loans. That means we actually fund and take security over the cattle, the sheep, the cows. We don't do rural mortgages. And in business, we don't bank a balance sheet. We do invoice financing. We'll do plant and equipment. So we go into niches, and in these niches we seek to gain a number one or two market position, and we seek to command a premium. What do we think the outcome will be? We think that we basically take the same, on the risk curve we enjoy the same risk as other banks. We're dealing with the same market, dealing with the same people, but on the return curve we're commanding a premium. So how's that going? It's going quite well so far. So we've achieved some good growth in specialist products, and more will come. It can be deceiving because it's off a low start base, but it's showing progress. We're moving ahead. And actually the rating agencies get it. Can we move to the next slide? Here are some comments from Standard & Poor's and Fitch, rating agencies for the bank. Standard & Poor's say, we're of the view that Heartland's strategy and chosen market target are distinctly different from its peers. resulting in less competition and lower contestability. Market penetration to chosen niches is gaining momentum. Heartland's strategy well articulated and understood with that throughout the organisation. That's important. Everyone's got to be aligned. Fitch say that our focus on niche banking products and services, we can achieve a leading market share, is allowing us to compete effectively. Fitch also make the comment that in its niches, Heartland has price-setting powers. I love to hear that. I'd love to hear that we have price-setting powers in niches. So talking about strategy, I think the obvious question is in a low credit environment, how can Heartland get to the next level of earnings? How can it get beyond 10% ROE, which is where we're heading now, 10% ROE, where we're heading now? How can we step up? Earnings in the mid-30s, how can we step up to the next level of earnings? We're not going to do it by just changing the mix of products. We've got to do it by attracting customers from other banks to Heartland, not on price, but on product, something that's more tailored to their needs. And we'll do it through acquisitions as well. We've got to be clever about acquisitions. We'll look at areas that we're currently active in, again, household, rural, SME. We'll look at entities that deal in products that are adjacent to those we deal with. We'll look at areas of demographic change, needs of baby boomers, asset rich, cash poor. We'll look at areas of savings. Maybe not everything will fit into the bank, maybe some things will fit into Heartland New Zealand. We need to be cautious. Any acquisition's got to fit with strategy and capability, and it's got to be shareholder value accretive. We get that. And in all of this, we've got to differentiate, we've got to exhibit our difference, we've got to execute well. We've done that so far, I think, I hope. We've got to be disciplined, and we've got to be relevant to the market we're selling to. And in the context of relevance, look, I'm doing okay on time. I'm going to throw up a little video now because I bored you long enough. But I'll throw up a little video, then I'll stand up here and take questions. Emma?
My name is Barry McCauley. Meg, come here, go back. Yeah, I've been milking cows here for about 25 years. This is my family farm. I'm a 5th generation on the land. Over the last few years, the farm's come across some hard times. Heartland have helped us through that. Yeah, my boy, who's 11, Finn, wants to take over the farm. He'll be a 6th generation, and Heartland's helped me get to where we are today.
I have been with Heartland now for 17 years, and it's been a very happy and trusting 17 years. The people there have always been available. We've dealt with Andrew Ford and his assistant Lisa. It's just a friendly place. It's a place you trust.
Hi, I'm Melissa Rose and I'm the Retail Operations Manager for Heartland Bank. I've been working for Heartland for 4 years and it's a fantastic company to work for. I like to think of Heartland as a different kind of bank, and as Heartlanders we get the opportunity to make a difference in our community and throughout New Zealand.
Hi, I'm Willie Losay from Sky Sport. Can I take this opportunity to thank everybody at Heartland Bank for your support of New Zealand Secondary Schools Rugby for 2013. Your support means that we're able to identify the future stars of tomorrow today.
Hi, my name is Shaquille Solomona from St. Peter's College. Rugby to me, it's not only a sport, it's definitely one of my passions. Just playing with 14 other blokes on the field who have the same passion and drive as you, it's pretty cool. It opens up pathways for young kids all around New Zealand. It wouldn't be possible though without the sponsorship we receive. Heartland Bank provide us with gear, equipment, everything possible for helping secondary school first 15s do their best they can in the competition.
We're dealing with local people, there's no issues. You get on the phone and sort something out, and it's been very successful and we're very happy with what we're doing.
Hi, I'm Tony Grantham and I am a current member of the New Zealand Blackjack squad. Heartland Bank has been a supporter of bowls for a number of years. They are now sponsoring me individually to help me achieve my dream of winning a gold medal at the 2014 Commonwealth Games.
I wanted to buy a 4-wheel drive truck so I could do more with this guy. Heartland helped me do that.
Thanks, Heartland.
So, sorry about the free advertising, but that's just about being relevant, because it's important that we're always relevant, that we're in contact with our market. So I'm going to stop there.